I'm Richmond Ajay, and my group members and I are presenting on behavioral finance, which is coordinating psychological and behavioral factor into the financial decision model to better understand and predict investors' behavior. When we talk about behavioral finance, we are focusing on how to explain the influence of psychology with the decision-making process of investors. This is classified in two folds. We can talk about the cognitive and the limits of arbitrage. The cognitive psychology talks about the process, how investors process, perceive, and also interpret information to help them make relevant decision-making concerning to financial matters. This can be explained based on some elements. You have the confirmation bias, experiential bias, loss aversion, overconfidence, disposition bias, familiarity bias, and mental accounting. Thank you.
Confirmation bias, that's a basic element of cognitive psychology, where an investor wants to hear an information which is in line with his or her belief. Example, a man who has a lot of trust or confidence in Anglo Gold Limited company in the stock market. So any information that he is going to hear or any negative information that he or she is going to hear about Anglo Gold Company Limited, which is not in line with his or her belief, is not going to accept that. Experiential bias is whereby an investor past experience has put in fear or has blocked him or her from investing in that aspect of investment, whether he or she is going to get more profit or not. So because of the past experience, he or she is not going to venture, or he or she is not going to invest in that investment vehicle. As you can see, a man who is just worried about the past experience. So even if the information is rational, information about the investment is very rational, he or she is not going to try to invest in that company.
Loss aversion. Loss aversion is also one of the elements of cognitive psychology. The issue regarding loss aversion makes most investors to avoid taking a risk, even if it earns high returns. As it has been displayed, this man is having a psychological problem with the investment he made.
Limit of arbitrage is an aspect of behavioral finance because it deals with the mind, human trait with regards to the stock market. Good. So in this context, the main idea is arbitrage. Good. Arbitrage is a stock market system in which an individual called the arbitrager take advantage of the discrepancy between two stock exchange markets. So for instance, due to the information that the person gets, and these factors that may can come into consideration is information. Information because the arbitrager what he does is that he buys the stock at a lower price, and due to the other market not having fair knowledge about the increase in price, goes there and sell it at a higher price. So the difference between that discrepancy becomes the profits they attain. But there's a limitation, and that is what I'm about to talk about today. And the limitation is due to two factors, which may include information and transaction cost. Information because sometimes others have the necessary resources to be able to gather information about a particular stock market. So when they're able to get the actual prices related to that stock exchange market, it means that when they buy it at a lower price, they're able to get a higher profit. Because when you get there and the information you get is that the prices are low, it when you get there, indirectly you're going to affect your profit. But when you get there and the prices are high, based on your information that you gathered, you're able to accumulate more profit. Transaction cost. That's one another factor that I have to also consider. So transaction cost. So transaction cost, this is when the cost is the cost involved in the buying and selling of the shares. Good. So sometimes you can earn more profit, but due to the costs that are involved, you realize that it affects your profit. So your profit will indirectly reduce. So this is the concept about limit of arbitrage. Thank you.
So to sum it up, Group 10, we're asked to present on behavioral finance, and it deals more about one's or investors' personal decisions with regards to investment. Can be classified in two different folds. That is the cognitive psychology and limit of arbitrage, as it has been explained. Thank you.